Hello, passive listeners, and welcome back to another episode of the Actively Passive Investing Show. As always, I'm Theo Hicks, and joining me is Travis Watts. Travis, how are you doing today?
Thrilled to be here, Theo. Thanks.
So today, as you can tell by the title, we'll be talking about or answering the question, is multifamily in a bubble? We've talked about something similar in the past. We've gone over some market reports, some forecasting reports to see where multifamily has been in the past year or so with the pandemic, where the experts project multifamily going in the future. So they'll be bringing that information back again and then using it to, again, answer this question, are we in a bubble? Should we be investing right now? Should we be waiting for the bubble to pop and then take advantage of opportunities? What should we be doing? So before we begin, as always, Travis will explain, although I kind of already did, why we're talking about this topic today.
Sure. Yeah, just to add on to that, a couple things came to mind here recently, which is why I felt this was appropriate. Now, the word bubble gets thrown out constantly, all the news headlines, CNBC, it's always the stock market's in a bubble and then, tomorrow it collapses and then you're unsure at that point. But, real estate's a lot more slow moving. And I wrote a blog last year in 2020, is now a good time to get started in multifamily? So that's what originally kind of prompted this topic. To your point, we've discussed it in different ways. But, I just had a call the other day with an investor and he's saying, it's just my luck. I'm always late to the game and everything. And he was comparing multifamily to cryptocurrency. And I thought, whoa. This is a lot bigger conversation to be had. It's really not comparable in that type of way. So I really wanted to address why that is. And not to say that things aren't in a bubble or that they are, but to define what that means so that you can decide for yourself if you think that anything's in a bubble. But today's topic, of course, is multifamily. A lot of concern over the virus. Obviously, that's been the last 12 months and everyone's focus. Cap rates continuing to compress. That was happening pre-COVID. That was a big topic about multifamily. Lots of people jumping in the sector. I've pointed that out. I got started in 2015 as a limited partner in syndications. A lot more training, boot camps, books, conferences, podcasts. I mean, it's just really exploded. But does that mean that we're in a bubble? So that's what we're diving into. I'll get started with just what I initially brought up, which is 2021 a good time to get started? Something that I only briefly touched on a couple episodes ago is, what is your exit strategy? I still think this is so important that, it bears repeating. What I mean is, when you're buying an asset, I don't care if we're talking about a single family home, a mobile home park, multifamily, who are you potentially selling to? And then what does that buying pool look like? What does that demand look like? So you really have three broad categories, right? You have institutional players, REITs and mutual funds and pension funds and all this kind of stuff. You have syndicators, private groups usually putting deals together, structuring that way. Then you have individual owners or maybe joint venture partnerships, family offices, things like that. So with institutional, I just want to reiterate this from a couple episodes ago. So you think about, hey, you're a big insurance company, you're a big pension fund. Okay, what do you need to pay out people, their monthly retirement and their pensions? Well, you need yield, you need cash flow, you need dividends, you need interest. This is what you need, right? And so when you have deep pockets, there's only so many asset classes to look at where you can go park $100 million in capital and get a consistent type of return, right? You can't be trading penny stocks, for example. So the way they're looking at the landscape is, U.S. Treasury yield is around 1%. It might be a little higher today, but it's hovering around 1%. It was below that here recently as well. 2% yield on AAA bonds, which are the highest rated bonds. Probably got 3% triple B bonds. Now you're starting to get a little more risk into the mix. You've got an S&P 500 index that has a dividend yield of 1.5%. So you take all that into consideration. It's all very, very low yield. I think we all know that we're in a very low yield, low interest rate environment. And then to speak a little bit about syndicators, JVs, individual buyers, et cetera, they're looking at the same stuff, of course, but additionally, things like certificates of deposit at the bank. I just looked that up the other day, paying 0.5% annually to lock up your money for 6 to 12 months, sometimes longer. Additionally, pretty much we'll just say zero in the bank as far as checking, savings accounts, money market accounts. It's so close to zero, it's not really worth even mentioning. 2% on annuities for folks looking to retire on fixed income. So here's the point that I'm trying to make. We're all looking for yield. Institutional, Main Street, you and I, everyone wants cash flow, yield, dividends, and interest. So that makes for a lot of demand on something that is producing that. So what produces that? Well, multifamily does. And we talked about before cap rates. So a cap rate, again, quickly, if you just paid all cash for a property, paid the operating expenses on it, the cap rate's basically your yield. So nationwide, we have approximately 5% cap rates across the US. So you get approximately a 5% return taking, having no leverage, no debt, no mortgage on the property. So that's a pretty conservative approach to investing in multifamily, especially for institutions who may have that $100 million to go put to work. Clip a 5% coupon. It sure beats all the alternatives that we just discussed. So to that point, there's a healthy demand. There's a necessary demand for yield. So I think that we still got some room to go, as crazy as it may sound, that historically cap rates were more like 8%. Now we're at 5%. That seems extreme and chaotic, but same thing with interest rates, right? It's just the environment that we're in today. The last thing I'll say on this intro topic is it really depends on what markets you're in. We talk a lot about that. Is it a good time to get started? Maybe not in San Francisco, maybe not in Manhattan. I mean, maybe, I don't know. But you got to look at the macro level trends, where people are moving to, what taxes, where taxes, I should say, are the highest, landlord tenant laws, et cetera. And so there's definitely markets that are going to be less lucrative right now compared to others, like in Albuquerque, New Mexico, for example. Cap rates are 6.5%. So it really depends. Compared to a San Francisco, I think they're at like 2.75 cap, something like that. So it's pretty extreme, right? That's a drastic difference. So we talk about Texas, Florida, the Carolinas, Georgia, Arizona, Idaho. We did an episode on that, top 10 markets based on a lot of different research, a lot of different metrics. So pay attention to your markets, look at where jobs and people are moving to. And that's a good, I think, intro to this segment. So I'll turn it over to you, Theo. That was kind of long-winded on just kind of your thoughts there and anything that you want to add to that.
No, that was all amazing, and it kind of just brings me back to the point we've talked about a few times, which is very key, and it's related to that exit strategy. And that's, you need people are going to invest in something, and so when you look at like absolute returns, you look at that absolute cap rate of 5%. You say, hey, well, I want to make more than a 5% return on my money, because 5 years ago I was making 10% easy. So that means that real estate isn't a bubble. I should invest because the cap rates are the return is going to be half what it was before. But you got to look at it relative to everything else. Like as Travis mentioned, keeping the bank is basically at zero. No point to even talk about what that return percentage is. You have all the other examples, and so these, it's the institutional players, syndicators, individual owners, you are going to invest your money in something. Your money's going to be somewhere. And so just because the return is not going to be as high as it was, say 5 years ago, again, it might be, but even if it isn't, it's more of a relative comparison as opposed to absolute numbers. I think that is something that's also super important, and it definitely relates to the exit strategy. Something else in the beginning is the blog post you wrote that we did a show on about, is now the right time to invest in real estate? And one of the key kind of things we talked about in that episode would be like your risk tolerance. And so, as you mentioned, it kind of, so it kind of depends on you, like what you want, what you're willing to do, how much risk you're willing to take. But at the same time, keeping in mind that you got to put your money somewhere. And so just because you might think that it's a little bit of a more risky time to invest in real estate, what's the risk of doing nothing and just living in the bank, right? And as Travis mentioned, there's people saying, I wish I would have gotten in at, everyone says, I wish I would have gotten in, 5 years ago, 10 years ago. There's always some time frame where they wish they would have gotten in. So 5 years from now, people are probably going to be saying the same things about now. And then the third thing, because Travis was talking about the markets to invest in, right? It depends. You can exceed these this 5% cap rate because it's just a national average in certain places. You gave the New Mexico example. Something else to keep in mind too is that the person or the group you're investing with is also super important. So Travis and I did like a 3-part episode on the kind of the 3 major risk points of the of a apartment investment in particular, and that would be the team managing the investment, the business plan / deal, and then the market, right? And so you could invest in one of these amazing markets, but the business plan doesn't fit for that market, or the team doesn't know what they're doing, and it's not going to perform very well. Right? You can invest in a really, really bad market on paper, but the team knows what they're doing. They found some very niche business plan that works really well in this quote unquote bad market, and they can perform very well. And so it's kind of balancing all 3 of those factors, and knowing that people have been successful in real estate during all times since real estate has been a thing. And so it's just understanding what works and what doesn't work, depending on what aspects, what part of the market cycle we're in. So all these stats are very important, but also at the end of the day, you could be investing in the place that has the lowest vacancy rate, the most rent growth, but then the team that doesn't know what they're doing, or it's the wrong business plan, they're still not going to perform very well. So on that same note, I've got a couple other statistics that we'll bring in that I think are very fascinating when it comes to how multifamily performed during the pandemic. And so compared to all the other asset classes, right, retail, office, hospitality, industrial, only industrial outperformed multifamily. So multifamily basically outperformed every other asset class except for industrial during the pandemic. Obviously, it was doing really well beforehand, but during this past 12-month period, it still performed very well. And so more specifically, vacancy rates dropped slightly, and now they're in a sense basically back to what they were pre-2019, but we're still talking about like in the 4% range, which is still historically very, very low, the lowest it's ever been. Because for the book we're working on, I did a very big deep dive into the last, I think, like 5 recessions starting in the 1980s, and vacancies just kind of consistently been decreasing, and slight little ticks up around the way, but overall going down. Rent growth overall was negative over the past 12 months, but it dipped and then it started recovering. Loan origination, something else that we've talked about on the show before, those slowed down a lot in 2020. Volume is down 20%, but now the projections are that it's going to rebound and be at just below the 2019 levels. And so again, 2019, great year for multifamily. So if 2021 is supposed to be, from a vacancy, a rent growth, a loan origination perspective, very similar to 2019, then it seems like we've bounced back. Now, one more thing that I want to mention really quickly that maybe Travis could mention is that this article that these were based off of, these forecasts, these projections, we're assuming that there was not going to, it wasn't taking like additional economic stimulus into account, right? So it's just saying like, if there's no more economic stimulus, here's what we think is going to happen. So that's something else to keep in mind.
Absolutely. Yeah, that's a Freddie Mac, by the way. Maybe we can put a link somewhere, or you can reach out to us for that link. But yes, Freddie Mac survey. So very knowledgeable folks in the space. So yeah, just to piggyback off of those topics, I think, so in my mind, I'm trying to look at kind of pros and cons here. I don't want this to be just a, a totally bullish, multifamily is the best, yada, yada. So let's look at some of those cons in fairness. So unemployment rate is still high. So, when you're investing in multifamily, it's all about your tenants. It's all about your renters and their ability to pay rent. People losing jobs is not a good thing. The government pulling away unemployment benefits, not a good thing, et cetera. These eviction moratoriums are still in place. There's still some negative elements to all of this. The unemployment rate, I believe, the last I checked, is still around like 7%. which is still a little bit high. It did spike up drastically in early 2020 when lockdowns first happened. It's kind of flattened the curve, so to speak, at this point. Rents in a lot of the largest markets are expected to remain depressed during this year. So something to think about as a limited partner if you're doing these syndication investments. Always look for conservative underwriting. If you're looking at projections of, we're going to take rent from 1,000 to 1,300 overnight, that's probably not realistic. So just kind of read through the lines there. And then vacancy rate is expected to increase slightly on a national scale, but to Theo's point, it really depends on the market that you're in, whether or not that's going to happen, and that is just a slight increment. So to the pros, the more markets are expected to see rent increases versus not. That's just looking forward. That's through a bunch of different sources, not just Freddie Mac. That's CBRE, Marcus and Millichap, on and on. I just did a speaking event at Best Ever Conference, and I tried to pull as many sources as I could from all different outlets just to paint the picture of what everybody, quote unquote, is thinking as far as forecasts go. And that would be very true in that case. So rolling out of vaccines, additional stimulus, by the time you're listening to this, that probably would have passed this 1.9 trillion stimulus package. We're still kind of on the works of that at the moment. Long-term fundamentals of multifamily are still on solid ground as far as just supply and demand, the amount of renters we have, how expensive it is to build new product, how much time that takes versus what's available now. All your fundamentals there. And yes, cap rates have compressed, but as we talked about, there's still a margin there that still looks pretty lucrative to a lot of institutional buyers. So think ahead, think of who you're going to potentially be selling your properties to. Yes, it's a crowded space. We talked about that. I did mention Albuquerque. Another example is Kansas City, Missouri. You have higher cap rates out there as compared to, even internationally too. You look at like Toronto in Canada. Got a lot of investors that are Canadian that I speak with, and there are like 3 caps out there in Toronto. So a lot of those folks are shifting over to bordering U.S. to start looking into U.S. multifamily and single family for that matter. So just something to keep in mind. London, Singapore, so many examples of lower cap rates than what we're seeing stateside, especially in certain markets. So with all that, we've had a lot of disruption in 2020. We all know that. To your point, Theo, multifamily really held up well, at least thus far. We're not completely out of the woods, but industrial did outperform, but most other asset classes didn't. So I'm continuing to invest on a personal note. I did a lot of deals in 2020 myself in the multifamily space. I'm still very bullish, and no, I don't think that we're in a bubble per se, but I'll leave it to you, the listeners, to decide for yourself if that's a bubble, and perhaps there's a strategy or an asset class you're more familiar with that potentially has a higher yield with lower risk, et cetera. And then maybe that's the right fit for you. But the way that I look at it from the complete landscape I see, this is still a great asset class, both for Main Street and for Wall Street investing.
I appreciate you doing the kind of like the cons as well as the pros, because I get very inspired. I start just talking like, oh, it's great, let's do it, let's invest. But so I appreciate you bringing those in. And one of them, because I did want to bring up one thing I did forget, it was the moratoriums, right? So you've got the eviction moratoriums, because historically when I did my recession analysis, when a recession hits, like more people start to rent, because it's just traditionally cheaper to rent than to own. But I wonder if though since previous recessions didn't have the eviction or the foreclosure moratoriums, that had an impact on why some of the metrics during this time around were different than other recessions. I think that'd be something interesting to look at, because recession happens, you lose your job, you're not going to go homeless. You need to just downgrade to like a small apartment or something. And so demand for multifamily goes up. Usually rents go up as well. Whereas now it seems like, according to the data, rents went down. I wonder if it has to do with the fact that people didn't have to leave their homes or their apartment if they could have some sort of declaration. So it sounds like, as Travis mentioned, when you listen to this, more stimulus is happening. So that should continue to kind of hold up and support multifamily, and then hopefully that continues until people can get back to work and get their money, and be able to pay their rent. And then once it goes away, things go back to normal. But you mentioned something too that I think would be good. People could definitely reach out to us, email me, Theo@joefairless.com. What your thoughts are on what we're talking about today, right? This is kind of all speculative or basing it off of different expert reports and forecasts. But again, none of this stuff's going to be perfect. They even say it in the reports. These are all just kind of averages and projections based off of certain assumptions and scenarios. And so let us know what your thoughts are as well. If you think that certain asset class will perform better, if there's specific opportunities you see that you're focused on, we'd love to hear that. And then if it's a lot of info, maybe Travis and I could have a quick talk about it on the show, or turn it into a 60-second question segment. So Travis, is there anything else you want to mention before you sign off?
Nope, I think we covered it. Appreciate it.
Perfect. Well, everyone, thank you. Best of your listeners, thank you so much for tuning in today. Make sure that, as I mentioned, if you want us to answer a question on the show, or if you want to answer a fast question on our 60-second segment, email me, Theo@joefairless.com, with those questions. So thank you so much for listening. Have a best ever day, and we'll talk to you tomorrow.